And I'm Heather Branch here with Abe, asking for his insight on what you want to be working on now as you get closer to retirement, or perhaps you're already in the first few years of your retirement. Want to make sure that the plan you have in place is still the right plan to help you achieve the goals you have for what's hopefully going to be many decades of happiness in this next financial phase of your life. So visit us at theretirementkey.com to get started on that conversation with Abe and his team at Abich Financial Services. We also have links posted in the show notes, or again, find us anytime at theretirementkey.com. As we're getting into the throes of it, sir, I mean, I do say the scary part is when I'm looking at my calendar, I'm already talking about September. Summer is wrapping up. Q4 is a busy season for you.
Flying by. Yeah. This is a great time for sports too. You're talking,
Yes.
Major League Baseball playoffs,
That's it.
college football,
College football is getting started
NFL
back
starting.
up. It is.
And then shortly after, even hockey and basketball, which I don't really follow those too much. But
Right.
exciting time of year. And then things just seem to fly at this point of the year. The summer is coming to an end, and we got the election coming up here shortly.
You said the E word.
The
How
E word,
dare you?
I know. We're just talking about early voting and all those things. And time flies at this point. And
it does.
It's really nice here in the Northern Virginia, DC metro area too. Fall is nice time of year.
Favorite time of year. Obviously, lots of things to do and look forward to. Thinking about taking advantage of the time, though. Let's talk about that. Using our time wisely, because I wanted to ask you, I didn't even realize this whole study that Vanguard put out, and it's a very interesting perspective, because apparently it's one of the biggest mistakes people make when they leave their jobs. They take the initiative to roll their 401k over to an IRA. Awesome. Right. Good for you. First step, yes. But then they stop there. And what happens is that 401k lands into an IRA that can be in a market type cash account. And it only pays a marginal rate of interest compared to what you could earn from stock market gains. And so the study by Vanguard found that nearly a third of rollovers were still sitting in cash 7 years later, Abe, missing those stock market gains. Here is wealth manager Ed Murphy on Yahoo Finance.
Unfortunately, it happens more often than it should. There's a couple of things that you can do to avoid it. One is you can stay in the plan. So when you change jobs or retire, you don't necessarily have to take the money out and roll it to an IRA. Oftentimes, it's better to leave it in the plan and get the benefit of better pricing, oftentimes diversified products that you can take advantage of. But to the extent that people do want to roll it over, it's really important that you consult with an advisor so that when you do roll it to another institution and you roll it into an IRA, the money doesn't sit there. It actually gets put to work based on what your investment objectives are.
Okay, a couple of questions, because he said it could be better to leave it in the 401k, but I'm worried about the kind of fees that you might run into, because your employer, you've been paying fees always, but the employer is going to take off what they might have been floating you some in fees there. So thinking about this situation, Abe, what could the cost be for somebody who makes this kind of mistake? And is this kind of thing you can work to uncover? And we always talk about a second opinion, a review process that you do at Abich Financial. Is this the kind of thing you're looking for?
Yeah, I mean, this happens all the time, Heather, where, what I find happens maybe more often is that people accumulate old 401ks and old workplace plans.
Yeah.
Then they, especially in the contracting world with like defense contractors and things, which is huge.
Sure.
Government contracting here in the DC metro area. And, sometimes people hop from job to job because the contracts end. They'll start a new job, a new 401k. They'll be with an employer for a year or two, another one, 3 or 4 years, another one. And they can easily build up 3, 5, 7, maybe even 10 accounts, including 401ks and TSPs, IRAs, and all these things.
Yeah.
And as you can imagine, the more accounts you accumulate, the harder it is to keep track. And so we see that a lot. We have also seen what this gentleman described, a rollover taking place. Money's going into an IRA, and then the account's forgotten about. And a couple comes in and says, you know what? Yeah, I haven't done anything with this money since I rolled it over. And this is one of the reasons why we're here, because the money's just sitting there and it's kind of dead. It's just sitting in cash, not losing anything, not making anything. And we see that from time to time as well. And especially when you add in husband and wife, you can imagine you can accumulate a lot of money and a lot of accounts on your own. You add in another partner or spouse, and oftentimes it's 10 or more accounts which is a lot to keep track of. And so consolidation, bringing all these dollars and all these accounts into a well thought out, actionable phase 2 plan, a plan that can help someone transition from their working career into retirement and then get through retirement successfully is what we help people with here at Abich Financial. That phase 2 plan versus the phase 1 plan where you're in your working career and just accumulating and maxing out your accounts.
Right.
And so we just had a couple come into us from Woodbridge with 1.6 million saved, a 4 on our risk scale. That means they are pretty conservative and they value principal protection, principal preservation, reasonable growth versus an aggressive, investor looking for 9-10% returns or more. I mean, they're happy with, not losing a lot and maybe making, 4, 5, 6%, something very reasonable, which doesn't take a lot of risk to accomplish. Right. Versus someone looking for a lot of return. What they found is, and what they already knew, is they had accounts everywhere. The husband, especially, is a electrician, has been part of different unions, 3 or 4 401ks, 401as, 4 different pensions. And he's like, Abe, one of the reasons why I'm here is because, and his wife is like 5 to 7 years older.
Okay.
We need your help in making some of these pension decisions as they come down the pike, which is basically the next 36 months. So in addition to managing the money, Abe, can you and your team help guide us on how to make the best pension decisions for my wife and I, because I want to get these decisions right. It's kind of like getting the Social Security decision right.
Yeah.
And so those were the problems for them. Accounts everywhere, dead money in cash, risky investments from 20 plus years ago, 4 pensions, not knowing how to decide on those pensions, and really not a clue on how to move forward, and kind of stuck, realizing they need a partner. They need a Sherpa, right? Someone to guide them into retirement and help them with all these decisions where there's not a lot of advice and guidance out there in the phase 2 retirement. There's tons of advice and guidance out there on how to invest and get to retirement, not a lot on helping someone get through retirement successfully. And so that solution for them was a consolidation, a well thought out consolidated plan, a phase 2 plan. So if you're watching and listening right now and you say, that's me, Abe, my wife and I, my husband and I, my partner and I have accounts everywhere, decisions to make, insurance policies, all this stuff, that financial junk drawer.
Yeah.
We want it all consolidated, a well thought out phase 2 plan. Go to our website, theretirementkey.com. Click on the Contact Us tab at the top of the page, and we can begin to have these same conversations with you about consolidation, 401ks, investments, pension decisions, all of it with you as well.
We have links posted in the show notes as well, so you can just click there, or again, visit us at theretirementkey.com. All right, another economic situation, thinking about timeliness, is where we are as far as our current climate, economically speaking. And I think that we've definitely talked about this here before, the idea of if you ask 10 different economists whether or not we're headed towards a recession, you're probably going to get 10 different answers. That just seems, it's all a matter of opinion for a lot of situations. And there are some people who even look at data from unusual sources, like sales of lipstick. We've even talked before about the men's underwear index. That's a real thing, apparently, that can be applied to
Things
a
are
recession.
going good. You're buying those silk when they're not, you're buying the 5-pack.
Right, but you're getting that label. You're buying the Ralph Lauren. You're not getting any Fruit of the Loom.
Right.
The Costco brand. Obviously, it's all fun and games to talk about things like that. It's not what you take seriously when it comes to trying to figure out where we are economically speaking, Abe. But what are the tells that you look for and metrics that you follow that could have you saying to a client, it looks like we could be headed for a recession?
Yeah, there are a bunch, Heather. I mean, there's some common ones that most people are aware of. There's the VIX index, which really tracks volatility, things like that.
Yeah.
Just a couple weeks ago, that VIX index, a couple weeks back when we were, down big time in the market, then up, and since then we've recovered. It spiked and hit its highest level since March of 2020. GDP contraction, gross domestic product going down, lower industrial output, growing unemployment, classic. Inverted yield curve, which we have had for quite a while now, which means that you can make more money and get more yield on a shorter term debt instrument or bond, like a 1 to 3 month treasury bond or 6 month treasury bond more than you could on maybe a 10-year note, right? 10-year bond, or 15, 20, 30 year. And that's typically a recession indicator as well. And so those are the things we look for. And some of those warning signs have been out there. And then you just also kind of look at common sense, and you look at the markets have pretty much been straight up from 2008 to 20, really the top of 2022. We had that correction when interest rates went up 11 times in 22 and 23. We've since then recovered. Okay, we're going all the way back to 2008. I mean, the markets have been up pretty much for like 16 years, not straight, but close to it.
Yeah.
We have ridden that wave. People have hit all-time values in their retirement plans, more money than they've ever have saved. The markets have hit all-time highs this year in 2024, I think over 30 different times, maybe 35 now. And what goes up must come down. And if you're nearing retirement and you're hitting new values higher than you've ever had before, maybe now could be a fantastic time for you to kind of clip in these gains and take some chips off the table, if you will, and start to get a little more conservative, realizing you've done extremely well, which you probably have. So we just had a couple come in and call in from Clifton, Virginia, just such a nice little neighborhood and really town, just a kind of a treasure of a town in Northern Virginia, near Centerville. Retiring in 5 years, 6.5 on our risk scale, just north of middle of the road in terms of their investment risk profile and tolerance.
Okay.
But when they came in because they have $3 million. They've gotten to this point, but they knew they were taking on more risk than they should be, and they're invested as if they're an 8.5, meaning of that $3 million in 401ks and IRAs, 85% of it's in stock, which is a high amount. 15% was in cash and bonds.
Okay.
Knowing they needed to get more conservative, knowing they needed to start putting all the pieces together if they were looking to retire in 60 months or less, no plan for phase 2 where all of this is consolidated and all these other things are planned for that are not planned for in phase 1. I mean, what does it matter to you when you're 40 about Social Security and when to take Social Security, right? You have 25 years ahead of you. What does it matter at age 40 to start planning for long-term care when you could have 50 years in front of you, right? It's better to maybe plan for those things in your 50s and 60s.
Okay.
And so the solution for them was a phase 2 plan, investment X-ray, second opinion on the investment analysis. How do you know where you're how do you know right now, if you're listening, where you currently stand, how everything looks and appears, what the pros and cons are of what you have done for your retirement if it hasn't been tested recently, if it hasn't been analyzed and diagnosed? And so that's what they came in for, that recession proofing analysis and portfolio X-ray, finding out where they stood today. And you are more than likely going to need to change things the closer and closer you get to retirement. All right, building in that growth and income, building in protection, preservation components, etc. So if you sound like this couple from Clifton, Virginia, and you say, Abe, we've done really well also. We've saved several $million. We've known how to save it, accumulate it. We've been disciplined. We've gotten to $3 million as well, or less or more. But we don't know where to go from here. We don't know how much risk we should be taking. We've heard that we should be reducing risk. We just don't have a retirement plan. We have a growth and an accumulation plan, but not a retirement plan. Go to theretirementkey.com, click on the Contact Us tab at the top of the website, and we can begin to have these conversations about your investments as well.
We also have links posted in the show notes. If it's more convenient, you can just click there to go to our website, which is, again, theretirementkey.com.